For the first time since Lunar New Year, the Shanghai Futures Exchange is reopening into a silver market that refuses to stay down. Prices have been slammed repeatedly, volatility is elevated, physical inventories are draining, and capital is rotating out of risk assets into hard money. When a market absorbs pressure and keeps recovering, it is rarely random. Something underneath is shifting. What's going on, everyone? Bernard, OG Analyst here. Before we go any further, this presentation is for educational and informational purposes only. It is not financial advice, not a recommendation to buy or sell any asset, and not a solicitation of any kind. Precious metals and financial markets are volatile and involve substantial risk. Always conduct your own research and consult a qualified financial professional before making any investment decisions. Now, let's walk through what is actually happening. Silver Western Spot is sitting around 88.50. Western futures are near 88. Shanghai Spot has been trading closer to 86, with Shanghai futures around 88 as well. Earlier today, silver was knocked down into the 85 range more than once. Each time it was pushed lower, it recovered. That matters. When price is hit repeatedly and fails to stay down, it tells you something about the quality of the bids underneath. Weak markets do not absorb repeated sell pressure and bounce back quickly. Strong markets often do. That does not guarantee continuation, but it suggests that there are real buyers positioned beneath the surface. Gold is trading around 5,228 on Western Spot. 2 trading sessions ago, both metals were meaningfully lower. Over those 2 sessions, gold is up roughly 4% and silver is up over 11%. During that same window, Bitcoin has been under pressure. That relative performance shift is worth paying attention to. For those who study short-term structure, the resistance zone between approximately 87.20 and 89 has been clearly defined. Price is currently inside that zone. What we have not yet seen is a decisive hourly body close above it. Not a wick, not a quick spike. A clean body close above resistance. Why does that matter? Because camping inside resistance without closing above it gives short sellers time to reload. If the bullish thesis is going to continue in the near term, the market needs to prove that the overhead supply has been absorbed. A confirmed close above 89 would open the door to the next structural levels around 90 and then 92. Until that close happens, the zone is still technically doing its job. But short-term structure is only part of the story. The larger narrative underneath the price action is where the real weight sits. The COMEX Silver Implied Volatility Index has broken above 100 again. Think of this as a stress gauge for the options market. When implied volatility is low, traders expect calm conditions. When it spikes above 100, the market is pricing in the potential for sharp, possibly disorderly moves. It does not tell you direction, it tells you tension is building. That tension has context. March silver open interest just days before First Notice Day has been sitting around 4,500 contracts. That represents more than 220 million ounces of paper silver. Open interest did decline by several thousand contracts recently, but the remaining size is still substantial this close to delivery. Most futures contracts are rolled or closed before delivery. That is how the paper market functions. But every contract that is not rolled becomes a delivery demand. February silver deliveries on COMEX have already reached over 23 million ounces this month. The physical pipeline is active. At the same time, warehouse inventories continue to decline. On a recent session, over 2 million ounces were withdrawn from COMEX silver warehouses in a single day, including withdrawals from major depositories. Total COMEX silver inventory now sits around the mid-360 million ounce range. The drain has not reversed. None of this guarantees a supply crisis tomorrow, but it does illustrate that physical silver is moving. Then there is the Shanghai side of the equation. During the holiday closure, global prices moved significantly. Shanghai is reopening into a gap. Large short positions exist on that exchange relative to available inventory. Reports have indicated that one major participant has been constrained from adding to positions and has faced higher margin requirements. When a reopening occurs into a price gap, participants must decide whether to defend, cover, or adjust. That dynamic introduces uncertainty, and markets do not like uncertainty. Zooming out further, the supply and demand picture has been tightening for years. Global silver production peaked around 2016. Current projections do not suggest a return to those peak levels until the end of this decade. Meanwhile, industrial demand has increased as a percentage of total consumption. Solar panels, electric vehicles, data centers, defense applications, and electronics all require silver. Industrial usage has risen from less than half of total demand to roughly two-thirds. The market has run deficits for multiple consecutive years. Paper pricing has not always reflected that imbalance in a straightforward way, but the structural trend is there. Mexico plays an important role in this story. It supplies roughly a quarter of global mined silver and a significant share of U.S. imports. Recent instability in certain regions, including road blockages and operational disruptions, has introduced risk. Whether those risks translate into sustained output reductions remains to be seen. But when geopolitical uncertainty intersects with concentrated supply, it deserves monitoring. On the geopolitical front more broadly, trade tensions have not eased. Tariff threats and countermeasures continue to circulate between major economies. Rhetoric has hardened. When governments escalate trade disputes, capital adjusts. Investors reassess currency exposure, supply chains, and sovereign risk. Military positioning in sensitive regions has also remained elevated. Certain conflicts appear paused rather than resolved. Pauses can hold, they can also break. Markets price probabilities, not guarantees. Now consider what is happening outside the metals space. Artificial intelligence capabilities continue to advance rapidly. A recent release of a powerful code-focused AI system triggered sharp moves in cybersecurity and legacy software stocks. Billions of dollars in market capitalization were erased across multiple companies in just 2 sessions. Large established firms saw double-digit percentage declines as investors recalibrated the value of traditional service models. Bitcoin also fell below key levels during this window, with leverage liquidations accelerating. At the same time, gold added hundreds of billions of dollars to its market capitalization in a single trading hour during peak momentum. Silver added over 100 billion in that same window. When equities and crypto are under pressure while hard assets surge, you are watching capital rotate in real time. Capital allocation is not emotional. It is comparative. Investors constantly evaluate where risk-adjusted returns appear more attractive. When confidence in paper assets weakens and confidence in hard assets strengthens, flows follow. There's also a deeper economic layer worth discussing. AI is not failing. It is improving rapidly. But technological acceleration can create friction in labor markets. White-collar workers account for roughly half of U.S. employment. Higher-income households drive a disproportionate share of consumer spending. If AI reduces the cost of tasks historically performed by higher-income knowledge workers, and if that displacement outpaces the creation of new high-income roles, wage growth could face pressure. That sequence would not necessarily result in collapse, but it could produce slower income growth, reduce discretionary spending, and strain on credit and fiscal balances. Governments would likely respond with policy tools, including deficit spending and monetary adjustments. Hard assets historically perform well in environments where fiscal deficits expand and currency confidence wavers. They carry no counterparty risk. They are not dependent on earnings growth or software adoption curves. You do not need to believe that extreme outcomes are inevitable to recognize that investors are pricing in higher structural uncertainty. Elevated volatility, rising precious metals, and defensive capital flows reflect that perception. Meanwhile, Chinese investors have been accumulating gold ETFs at a historic pace. Over a recent 5-month period, Chinese gold ETF holdings rose more than 50%. That is not a trivial retail impulse. It represents coordinated capital movement within the world's second-largest economy during a period of domestic economic adjustment and geopolitical tension. The gold-to-silver ratio offers additional context. For years, it oscillated between roughly 80 and 100. When silver spiked dramatically earlier this year, the ratio compressed sharply, briefly touching the mid-40s. It has since stabilized closer to 60. A sustained compression of the gold-to-silver ratio suggests that silver is no longer behaving as a chronic laggard. It is participating more aggressively during risk repricing phases. That shift in behavior can matter for portfolio construction and macro interpretation. Now, it is important to present the case for caution as clearly as the case for continuation. High implied volatility cuts both ways. When volatility is elevated, violent downside moves are just as possible as upside spikes. Coordinated interventions by large institutional participants, sudden liquidity events in other asset classes, or macro surprises can trigger sharp pullbacks even within strong structural trends. The Shanghai reopening could unfold calmly. Chinese institutions may choose to respond gradually rather than aggressively. Mexico's supply risks may not translate into measurable production declines. Delivery demands on COMEX may normalize. No single data point guarantees follow through. Experienced traders understand that even high probability setups can fail. Edges play out over time, not in a single session. The structural case for silver may be compelling, but timing remains uncertain. Markets can remain mispriced longer than participants expect. At the same time, the convergence of multiple forces is difficult to ignore. A physically tightening silver market, documented warehouse withdrawals, meaningful open interest heading into delivery, and cross-exchange positioning stress are occurring alongside macro conditions that favor hard assets. Trade friction, fiscal expansion, AI-driven labor uncertainty, and capital rotation away from risk assets are reinforcing the narrative. When physical fundamentals and macro flows align, price eventually responds. The only open question is pace. Tonight's Shanghai reopening will provide new information. A decisive push above the defined resistance zone with confirmed body closes would signal that supply at that level has been absorbed. Failure to break through, combined with heavy selling, would suggest that further consolidation or retracement is possible. In either case, the data will speak. The responsible approach is to observe, verify, and respond with discipline rather than emotion. CME reports, warehouse data, World Gold Council statistics, and Silver Institute supply figures are publicly available. They can be checked. They should be checked. Markets are not battlegrounds of certainty. They are arenas of probability. Right now, silver is demonstrating resilience under pressure. Gold is attracting large-scale capital. Volatility is elevated. Physical inventories are moving. Geopolitical and technological shifts are increasing uncertainty across asset classes. Those are facts. How one chooses to position around them depends on risk tolerance, time horizon, and personal financial context. Protecting capital requires logic over hype. It requires patience over impulse. It requires accepting that no analysis eliminates risk. As the Shanghai session unfolds and new price data prints, we will gain clearer insight into whether the structural tightening narrative is accelerating or pausing. Until then, measured observation is more valuable than prediction. Stay disciplined, stay informed, and above all, make decisions grounded in evidence, not emotion.